Joining us right now is Pacer ETFs President Sean O'Hara, talking about this market. Sean, great to see you.
Thanks for having me.
Thanks for joining us.
Congratulations, by the way, to you and your whole team and Dagan on your continued ratings dominance.
Thank you. Thank you. We're proud of it. We have a great show every day.
You guys do a great job here.
Yeah, fantastic guests. So smart every morning. No, I mean it. Don't I always say that every morning we have the smartest people in business on this program and in politics?
Starting with you.
No,
icon who works tirelessly.
Thank you.
Brilliant. I'm lucky.
She's brilliant. No. I'm lucky. Okay, so Apple is one of your top picks. What do you think that tells us about the broader market? Is it just an Apple story, or does this tell us something more?
I think it's a bigger tech story more than anything. Apple's part of it. You know, I was looking this morning, and I'm in the ETF business at Pacer. We're in the ETF business. So much of the attention in the ETF business is focused on these broad-based, inexpensive ETFs, right? But we have an ETF that's based on the NASDAQ 100. The NASDAQ 100 year-to-date is up 13%. The S&P is up 7%. Everybody's thinking the right thing to do is to buy the 7% when the 13 is out there. Now, I think what holds them back is that we think of the NASDAQ like we used to think of it back in the old days when there weren't real companies. Apple trades at 17 times earnings. They generate $55 billion a year in cash flow. So it's a new NASDAQ today. I think the NASDAQ today is the new bellwether, if you will, for a large cap.
I like that.
Is it also, you talk about the NASDAQ 100, it's the big companies that are dominating. We kind of live in this world, don't we, where the big guys are doing really well, but the startups just kind of aren't showing up and driving the market higher.
Once they get to be viable, the big guys will just scoop them up because they have so much cash. It's like, I was telling this to a friend of mine the other day, it's like if you ever watch poker on TV, the guy at the end of the game who has the big stack, he can push the whole table around if he wants. Well, Apple, Facebook, Amazon, those big five stocks, if you will, that dominate all the returns in the markets, they can push everybody around, and they'll just wait. And if something actually looks like it's going to be a disruptor and emerge, they'll probably go in and buy them.
Is that healthy? I mean, don't we want the little guy startups out there, you know, kind of turning into the next big thing?
You know, I guess that's the unknown, if you will, right? There's always unintended consequences for everything that people can't see around the corner, so we'll see,
But I
right?
think what you're saying is this is a much different NASDAQ. It's more fundamental, and it's stronger companies that are generating cash flow and generating real profitability, rather than looking at the NASDAQ in 1990 when we were sort of investing in it because of clicks to a website.
Yeah, that's what you're saying. Yeah, we're not talking about clicks and eyeballs count. It's revenue, earnings, sales,
and earnings,
cash flow.
Cash flow matters. Cash in the bank. I was looking at an article the other day now, but $250 billion. They could, as insanely valued as Tesla is, they could buy the whole company with a fraction of the cash they have.
So should they do that? I mean, what should Apple do with all this money? That's
there's certain targets, I think, out there. I think the list I saw the other day had Disney on it, which would take 100% of their cash. Had Netflix on there, which would take, you know, like 30%. Had Hulu on there. Had EA on there. There's a lot of different potential targets. And I guess what you're trying to figure out is how do you integrate them? We were talking the other day in our Monday morning meeting with all of our folks the other day about Amazon. And one of the things that Amazon's like, I mean, Amazon is a behemoth, right? And it's in the NASDAQ 100, which, by the way, I start to get a little nervous with what's going on. You know, like all bull markets end in euphoria and all bear markets end in capitulation.
But are we there now?
I don't think we're there yet. I think when Apple's at 17 times earnings, you're probably not. But Amazon is another company that has huge cash and can try to figure out how to assimilate things. And so they're starting to think about, like, should we just make our own delivery company versus sending out profits?
Everybody's looking to who's
and that's the way these big companies will squeeze every little bit of they can.
Before you go, the VIX, top story in the journal, Dagan. What's the story? Volatility.
There is no volatility, essentially. There is a giant amount of complacency in the market where there is essentially no fear. The VIX yesterday hit its lowest level since 1993. And that makes me nervous, that nobody sees anything bad on the horizon, for lack of a better phrase.
Does that bother you?
That's definitely something that I think should be on people's radars. As I was saying, that, you know, between euphoria, the VIX at 9 is in a euphoric range, like nobody sees any risk anywhere. And that euphoria and then capitulation, there's a whole series of rationalizations people make, like when we own stocks, like, oh, buy the dip, oh, they're cheap, now it's gone down so much I can't sell now, and then holy cow, get me out, right?
Yeah.
And so we think it makes sense to have a plan in place in advance. We use a trend following strategy to move in and out of equity positions based on broad market indexes to provide some downside.
The last time the VIX was this low was 1993. That was the beginning of a great run for the stock market. So maybe it's not such a bad thing that the VIX is so low.
We had falling interest rates as the tailwind for stocks, which is not going to happen.
It's actually remarkable that that volatility is so low at a time when central banks are pulling all this easy money back.
Yeah, it's interesting that it's the lead story in the Journal, just pointing out that there's no anxiety.
No.
Everybody's bullish. So we'll see about that. Sean, good to see you.
Thanks so much.
Thank you so much. Sean O'Hara is president of Pacer ETFs.